Welcome to Davie Kaplan's first estate tax update. I have a couple of housekeeping items before we get started. If you are watching this presentation live and you move your mouse over the presentation, the screen will darken, and you'll need to move your mouse away from the screen so that it brightens up and you can see the slides in the presentation. Secondly, at the very bottom will be the controls for volume and full screen. These will present themselves anytime the mouse is moved over the presentation, so you can do those adjustments. Again, welcome. I'm David Pitcher, and I'll be leading this discussion going first. My purpose here is to discuss what the current law is for estate planning and compare it and contrast it to the Democratic proposal. Obviously, there's an upcoming election, and it will have an impact on the state as well as income taxes as we go forward. Following my presentation, Marcus Kroll will present some ideas regarding how to deal with all of these changes in the law and what you can do to minimize estate taxes upon your death and to make sure that you maximize your individual goals for your estate. And then thirdly, Fran Ostrom of Davie Kaplan will be making his presentation regarding investment planning, given all of the discussions that I will have and that Marcus Kroll will have. So again, welcome. So right now, under federal law, the estate exemption amount per individual is $11,580,000. That's per individual. So for a married couple, you would double this to a little over $23 million. And that went into effect as a result of the Trump tax law several years back. The current Democratic proposal is set at $3.5 million. That's the amount that was available before the TCJA law. So there are some commentators that believe that it won't be $3.5 million, it might be closer to $5 million. In any event, that's between an $8 and a $6 million change in the amount that each individual can leave to their heirs free of estate taxes under the federal provisions. The next proposal is step up in basis. Right now, when you die at your date of death, or the alternative date, should it be lower, your estate is valued at fair market value. And which is called step up in basis. So it didn't matter what you paid for the asset, it's what it was its fair market value at date of death, and adding up all of your assets at date of death determines how you compare to the $11,580,000 under the current law. In the Democratic proposal, they're repealing fair market value at date of death. And furthermore, if you can't prove basis, it becomes zero. So that becomes a problem when you're looking at fair market value versus zero. That could generate significant taxes. Now, I'm going to date myself. When I came into public accounting in 1978, the Congress at that time and the president had had done away with the step up in basis rules, and we actually tried to make those computations in 78 and 79 and 80 until that law was ultimately repealed. And the problem you have is that if you have a 70 or an 80 or a 90-year-old parent and they bought an asset, perhaps their house, in the 40s or 50s, or they bought Kodak or Xerox or some other stocks back in the early years, and they've held them for that entire period of time, it's going to be very difficult, if not impossible, to determine initially what they paid for the stock. Secondly, if they elected the dividend reinvestment program, which many individuals did back in those days, especially with utility stocks, they would continue to reinvest those dividends over the years. You could have 40 or 50 years worth of computations that need to be made in order to come up with what that basis really is. And again, if you can't prove it, it's zero. So this could be very, very significant because it's a record-keeping problem. And it's a memory issue. I mean, sometimes I can't remember what I had for breakfast in the days before. How are you going to be able to go back and determine what your basis is in all of these stocks? So this is going to be very difficult. And Congress determined back in the 70s and 80s that it was a law that was unworkable. I don't know that they're going to be able to prove anything different as we move forward here. So something to keep in mind. In terms of gift tax, remember, anybody can make as many $15,000 gifts as they choose to as many people as they want to, without there being a ramification for gift taxes. Right now, gifts beyond $11,580,000 cumulatively during your lifetime are going to be taxed. Under the Democratic proposal, they would reduce that amount to $3.5 million. And again, some commentators think that 3.5 may be a little low. That's what's in their platform, but they may think that $5 million may be the more acceptable level. Only time will tell on that. Next, we want to talk about the transfer tax rates. It's a progressive scale that goes from zero at assets at 11,580,000 and below, up to a maximum of 40% under the current law. Under the Democratic proposal, that would ramp up to 45%. And remember, it would be applicable to gifts at above 3.5 million. So those gifts and that estate above 3.5 million would be taxed, beginning at lower rates, but ramping themselves up to 45%. And that 45% ramp-up rate is still far less than the current law prescribes. Now, the other thing that happened when they enacted the current law was they put in a sunset provision. And that sunset provision says on January 1st, 2025, the 11,580,000 reduces back to 5,490,000, which is where it was before the law was enacted. So as a result of that, it goes back to 5,490,000. It does get indexed for inflation as it moves forward. And remember, this sunset on January 1, 2025 is another 4+ years away. So when you think about it, we're going to have another election and another president before this sunset. So we're really not sure what's going to happen going into the future. So our feeling is that we need to do things to prepare now under the current situation to be ready to take action before December 31st, should circumstances change that cause you to want to protect more of your assets at your death. The next item I want to talk about is the current situation here in New York State. Right now, the New York State exemption amount is the $5,490,000, which was enacted because the New York wanted to follow the federal, and they were comfortable that the $5,490,000 on an index basis going up would be an appropriate amount. The chances are, if the federal rate drops from the 11,580,000 down to $3.5 or $5 million, New York State will likewise reduce its exemption amount to mirror the federal amount. Not a surety, but it's very likely that they wouldn't allow their exemption amount to be higher than the federal amount. Historically, that's never happened. New York State does have an anomaly in their law, which is dangerous for those who don't understand it, and that's called the cliff. And what the cliff is, it says that if your estate is more than 105% of the exemption amount, then the entire estate is taxable. So as an example, if you look at the difference between the $5,764,500 and the $5,490,000, that's approximately a $274,000 difference. So if your estate is between $5,490,000 and $5,764,499, you're taxed on the $274,000 at New York State rates. If, however, you go $1 over the $5,764,500, the entire $5,764,501 is taxable, and that's what's called the cliff. The maximum rate is at 16%, and right now there is no New York State gift tax. What that means is that you can make unlimited gifts, the $11,580,000 per individual. There's no gift tax in New York. There is, however, a clawback provision, so that if you make the gift today and you die within 3 years of the date of gift, New York will claw back that gift for purposes of determining how your estate fares against the $5,490,000 exemption amount. So if that clawback results in that being above the $5,764,500, it's going to be taxable in New York within that 3-year period. If, however, you live beyond the 3 years from the date of gift, then it's a tax-free gift for New York State purposes as well. So there's a lot of thinking to be done here in terms of making gifts, determining what New York will do should there be a change in Congress and a change in the presidency, and the impacts that it's going to have not only on federal taxes, but the trickle-down effect that you're going to have as it applies to New York State estate and gifts taxes. So I've thrown in here the individual rates. And the reason I included those is when we're doing estate planning, we also have to take into account the impact on individual tax rates and the impact that it may have on your position. So for personal taxes, your individual tax, the current law has a top bracket at 37%, and it's on income beyond $518,000, $501. That law sunsets at the end of 12/31/25. The Democratic proposal would bring back the pre-TCJA rates at a top bracket of 39.6 on income greater than $400,000. So that's a significant difference. It also affects the lower rates below that, and where those will sort out hasn't been spelled out specifically. I think for the lower income tax brackets, they may be similar, perhaps less, depending on Congress, but we never know. As it relates to capital gains taxes, this is significant. Right now, we have a 15% or a 20% rate, depending on your adjusted gross income. You add to that, again, a 3.8% Medicare surtax, but that's also dependent on your income. The Democratic proposal would be to take that 20% rate all the way to 39.6 on capital gains over $1 million. So that is significant. It's a doubling of the rate. And again, it's going to get the same 3.8% Medicare surtax, and then carried interest, which would be subject to ordinary income as opposed to capital gain treatments currently, which is also a very significant increase. On the Social Security side of things, right now we pay Social Security taxes at 6.2% on wages up to $137,700. and that's indexed for inflation. The Democratic proposal, and for Medicare taxes, there is no limitation. On the Democratic proposal, the 6.2% on wages up to 137.7 would remain the same. And then once your individual income goes above 400,000, then the tax would kick in again at 400,000 and carry on an unlimited basis. So that's going to have an impact on S corporations, on LLC pass-through entities, how those are taxed, and it's going to have an impact on valuations, because valuations are typically done based on earnings before interest, taxes, depreciation, and amortization. So it's going to have a trickle-down effect into the valuations of closely held businesses and real estate holdings and the like. So it's going to have a significant trickle-down effect on those valuations. And those valuations, if you recall, going back to our initial slide, is going to have an impact on the fair market value at date of death compared to the estate exemption amount. And it's also going to have an impact on the step up in basis, which you would also lose on your operating businesses, your real estate holdings, and other investments. So it's a significant issue that that you're going to need to pay attention to as we go through our planning. So what we're going to do now is we're going to turn the presentation over to Marcus Kroll. He's going to talk about an overview of the changes as well. He's also going to discuss various strategies that we can employ in order to minimize the taxes and maximize the wealth that can pass on to your heirs, and for those who are charitably inclined, the opportunity to use charitable giving as a way to manage your estate tax bill and the wealth you transfer to your heirs.
So, thank you. I am Marcus Kroll. I am a trust and estates attorney. I have a boutique practice, the Kroll Law Firm. We do very little, we do a lot of it. Simply trusts, estates, elder law, special needs planning, probate, guardianship. There's 19 of us. We are one of the best kept secrets in town because I believe we are the largest teeny boutique in Rochester. So nonetheless, I'm going to take you through some of the changes that have already been discussed at a high level, just in case you're going to watch this in separate chunks or just to review, and then go through there with some of my thoughts. So let's rock and roll. Here we go. As we discussed, the annual gift exclusion is still $15,000. With the portability, you've got $23 million for your state tax exemption at the federal level, 5.8 in New York. No gift tax in New York. Keep that one in mind. This is going to be very important. And then we always have our basis issue. We have the ability to retain the step up with some of our documents, although some other documents do not. If you have existing trusts, this is potentially something that you should be aware of, especially given some of the pending changes that are coming. Now, what are those changes? How are we going to predict the future? If I could do that, I'd be the most successful lawyer on the planet. So we have the existing regime, and if Trump gets elected, then Trump gets elected and nothing changes immediately. If, however, Biden gets elected and controls Congress, his proposal is to eliminate the step up in basis, which could have pretty devastating effects. This would be a system like what they've got in Canada, where every time there's a transfer, whether that's for fair market value between people, whether there is an event like death, then unrealized appreciation would be taxed. And if you can't prove your basis, it's going to be zero. Now, are there going to be exceptions between spouses or children or trusts or different rates between those entities? I don't know. That's for the politicians to work out. And if we know anything, they will make decisions without really even realizing it. If you look at the Secure Act, for example, that's currently demolishing middle-class families, and nobody anticipated that or knew it, or maybe they did. If nothing changes. We've got our sunset, which we've discussed. That's January 1st, 2025, and everything's going to revert back to the old 2017 numbers, which will get adjusted for inflation. Now, I can pretty confidently say that if anything deviates substantially, there's no way that New York is going to let their tax regime be more generous than what the federal government is providing. As you'll recall, we recently raised our estate tax exemptions, even though it definitely wasn't the taxes, it was only the weather driving New Yorkers out. But for some reason, we still raised our estate tax exemptions and tried to get them in line with the feds. So what can you do? The number one thing that I do with my clients in uncertain tax times is disclaimer planning. So remember, I'm not really concerned with my clients while they're alive beyond whether or not they can pay for their long-term health care. My world really revolves around life and death, meeting interesting people multiple times a day, imagining the worst things that could possibly happen to them, which is why I go home and have a drink most nights. But if we are going to imagine that the tax environment is changing every year, then we will consider disclaimer planning. To put it in English, if I have a disclaimer will, my will says I give everything to my spouse. If my spouse decides to receive those assets, they inherit with the unlimited transfer between spouses. If, however, my spouse decides to reject some of the assets that I've left them, my will says any assets that my spouse disclaims go into a trust, a disclaimer trust. My spouse is the beneficiary of that disclaimer trust. They can also be the trustee of that trust, although I typically recommend they be the co-trustee, because if you're your own trustee, there are certain restrictions that need to be placed on there. The ascertainable basis or ascertainable standard you might have heard about. Here's the flexibility for this. The surviving spouse can decide what to inherit and what to disclaim based on what their financial situation is, how much control they want to retain, what the current tax environment is, and what the potential tax environment might be. They can also make that determination based on what's going on with their family. So that provides a ton of flexibility for my clients. And generally, if they're within the threshold of having a taxable estate, it works great. So if I've got a couple with $10 million in New York State, I can reduce their estate tax obligation to zero using this disclaimer planning. They would, for example, one spouse would make a decision that their estate would be $5 million and they would put $5 million into the trust. When they die, their estate is under the New York exemption, which is close to $6 million, and they've used the deceased spouse's exemption to fund that trust, which again is below the New York State exemption, so no tax. What else can we do? Family limited partnerships. These are interesting beasts, and they are popular with my clients who generally have more complex estate plans. You have a general partner and a limited partner. The general partner, who could own a very small fraction of the whole interest in the partnership, retains control. The limited partners do not have control. They do not have some liability issues as well. So because the limited partners can't control the partnership, the shares of the partnership are discounted by the IRS. And this is still good law. We hear all the time people rumbling, oh, the IRS is going to get rid of this, or they're not going to do this. As far as I've seen, this still exists, and the IRS has not taken any steps other than kind of chatted about getting rid of these options. The nice thing with the family limited partnership is that in addition to having discounts, so if I have a large estate, I could discount it to have a smaller estate. I can put things that are not in, let's say, New York into this family limited partnership, which could be another state's family limited partnership under those rules of another state. But I would transform real estate that's in New York, Florida, and Texas, all to wherever I live, thereby avoiding the state administration process in all of these different states, simplifying the administration of my estate. These also work really well with a strategic gifting plan where every year you can use your annual exclusion to gift more shares of the partnership from typically the parents down to the kids. And remember, you can use each parent's exemption and they get a discount. So that $15,000 can become 30 with the splitting the gift, and it can become substantially more with the discount and on an annual basis. So again, these are not for everybody, but they are great for people with more complex estates who are facing some estate tax obligations. And they work in conjunction with disclaimer wills as well. You can always disclaim shares and disclaim other assets as part of your estate plan. Now, the other option is freezing the value of the assets. If I know that I have something that's going to appreciate, I can put it into a trust today while I'm alive. So that's a living trust. There are many, many, many flavors of living trusts. I could potentially get asset protection by putting it in the trust, depending on how much control I have over that asset. I could put life insurance into a trust, and I'm a big fan of a second to die single premium policy. So me and my spouse, we say we want to put X dollars in this trust. We know we have a need when we're dead to have a benefit to our heirs. Maybe we want to use that to pay our estate tax obligations. Maybe we want to use that to cover the income tax obligations that would come from liquidating our IRAs and 401ks. Because remember, IRAs and 401ks have to come out in 10 years now with certain exceptions, whereas before we used to be able to stretch them over the lifetime of a beneficiary. So that's going to have pretty disastrous effects with regard to growth and appreciation and having to pay the taxes of taking this out. Or we might just say, I want to plant a tree that's not going to bear fruit in my lifetime. So I have 100 grand sitting around. I could leave it in a money market and get 1%, or I could do a single premium second to die life insurance policy and leverage that and know when I die, this amount of money is going to go to my kids. Again, huge planning tool because we can insulate that asset and we can protect it if we go to a nursing home, if we have potential creditors, it's all there. We could do a charitable trust. The benefit of the remainder trust is I get an income tax benefit today. The benefit of a lead trust is I get a future potential state tax benefit. But either way, I can freeze assets there or reduce my obligations. And then we have a whole variety of trusts. The hip new cool one is the spousal lifetime access trust, but this could be any sort of irrevocable trust where I have interest in a business or I have stocks or something, a house, something I know or I really think is going to appreciate. I can put it in the trust. And if that asset is worth $100,000 today and $1 million at my death, I've only used $100,000 of my gift exemption. And remember, New York has no gift tax. And that $1 million that it's grown to is not includable in my estate. So the spousal lifetime access trust is, I create a trust for the benefit of my spouse. And again, they're super hot to discuss today, although I'm not seeing a lot of clients use them. Typically, they'll use one of the other trusts that I discussed or irrevocable Medicaid trusts. But the whole concept here is freezing assets from future appreciation. And again, with $23 million of lifetime or death at the federal level and no lifetime gift tax in New York State, this is a tremendous planning opportunity for people. If they are afraid that the federal is going to go down, they can absolutely dump a ton of money into one of these trusts using that big 23 million federal and the unlimited New York and really freeze assets. Of course, you're giving up some control. So the balancing act is always, what level of protection do I want? Typically, the more protection I get, the less flexibility or access to these assets that I have. So as you can see, it's an art and a science, totally case-by-case basis with every person that I meet, which makes my job interesting. So finally, our major concern right now is the income tax. As I mentioned, most clients, the majority of their wealth is in their house and then their retirement accounts. And if these retirement accounts are being forced to get liquidated in 10 years, that means if I've got a kid who's 18 who just inherited my $1 million IRA, they're going to get 100 grand a year. Theoretically, we're making the numbers easy, from age 18 to 28. So think, what would you do with 100 grand a year in that period? It is difficult to protect this just from a protection standpoint, let alone the tax consequences of liquidating these IRAs rapidly. So the key here, because we have elements of financial planning and investment and growth, we have elements of taxation, income tax and estate tax, and then the legal framework. What I do is I'm an architect, I build a house, or I build the blueprint for a house that might not ever be built in the case of, for example, disclaimer trusts or trusts under wills. Everybody's got to talk to each other. It's super important that the financial person and the tax person and the lawyer are all on the same page, are comfortable communicating with each other, and that the client shares information with everybody. In that way, we can maximize what is available to the clients. Again, my job is to pretty much maximize government benefits available to people and minimize the amount of money they give to the government for those benefits. So if you have any questions directly for me, you can call me or email me, no problem. I know how to use technology, and we'll go to our next presenter. Thanks.
Thank you, Marcus. My name is Fran Ostrom, and as the Director of Financial Services for Davie Kaplan Wealthcare Advisors, I'd like to take this portion of our webinar to address financial planning and its ability to help with the strategies that Dave and Marcus have discussed. Financial planning can have various meanings for clients. For purposes of today's session, think of financial planning as a conversation about your finances and goals. We use planning to create a customized roadmap to help you navigate through the financial challenges that are unique to you and your family, and ultimately to create a path to successfully achieving your long-term goals. Your financial plan or financial roadmap begins with a review of your financial position, projected cash flow, discussion of priorities, life-changing events and assumptions, all key components that can not only have an immediate but also long-term implications. We continue with an analysis of your current course of action, designing potential alternative strategies for your goals, determining which alternative strategy or strategies work best for your plan, and going forward, monitoring your progress. A financial plan frequently incorporates the following areas: portfolio planning, insurance planning and risk management, employee benefits planning, education planning, retirement and financial independence planning, income tax planning, and estate planning. Some or all of these planning topics are combined into a comprehensive and tailored plan that prioritizes your long-term goals, and then through a series of periodic meetings, checking back in to ensure the plan remains on track to help achieve your goals. Let's review some questions that estate and financial planning will address. Should I take gains or losses this year or next? How will potential tax law changes affect my decisions? What impact will these changes have on my future cash flow? Am I using my retirement plans correctly? Am I underfunded? Should I try to accelerate or delay income and expenses? Am I withholding enough? Or do I need to change estimated tax payments? Are my investments tax efficient? Can I take advantage of deferred compensation? Do I have the right education savings plan for my state? Have I implemented the charitable portion of my legacy plan? A financial plan can help to identify and prioritize the next steps in addressing the key areas we've touched on in today's webinar. Your to-do list should include the following considerations for your next planning meeting at Davie Kaplan: Roth conversion, beneficiary review on all insurance coverage and retirement plans, qualified distribution, qualified charitable distribution, 529 accounts, maximum funded health savings account, also known as an HSA, term life conversion, an estate planning update, and an insurance review. If you'd like more information on financial planning or the next steps, please reach out to your team at Davie Kaplan, and we can respond to your questions or help you begin the process. And now, I'd like to turn the webinar back to Dave Pitcher to begin our question and answer portion.
Thank you, Fran. That was a great presentation. What I'd like to end our presentation with today are some key planning questions. And these are ones that we think as a starting point in terms of navigating your estate and gift planning as you move forward. So some of the key planning questions that we think are important is, should I do something for our estate planning before the end of the year? We know what the law is now. We don't know what it's going to be going forward. It's important to sit down and if you're a single individual, to think about your goals and your wishes and how you want your estate to pass to your heirs. If you're a married couple, you want to be in a situation where you sit down and you talk about it and how you want your family or the like to receive your gifts and minimize the amount that goes to the federal and state governments and maximize the amount that goes to your heirs. The next number of points here are always important things to think about, and we put them up there as a reminder. When did I last review or update my will or our wills? Those are things that should be re-reviewed at least every 5 years. Some clients do it sooner. They look at it on a much more frequent basis. You know, as your family grows and your family ages, circumstances change. Minor children become adults, and adults mature and display different tendencies and different behaviors and so forth, some of which we like and some of which we may not be as happy with. But those will have an impact on how you organize your estate and how you pass it from your generation to future generations. A very important question to re-review is beneficiary designations. Those beneficiary designations for IRAs, retirement accounts, life insurance, and the like are not changed by your will. They're, by operation of law, when you die, that life insurance is going to go to whoever the designated beneficiary is. The IRA is going to go to whoever the beneficiary designated is, as will your retirement accounts, your annuities, other types of investments. A number of clients use a thing called a transfer on death designation on some of their bank accounts and the like. Those things move independent of what you say in your will. So if you had a savings account and you wanted it to go to your grandson or your granddaughter, and you didn't, and you put somebody else, your son or your daughter or another family member on that account as a transfer of death designation, that overrides your will. So you want to get your will out, you want to get your beneficiary designations out, you want to identify differences and whether you want those differences there or not, and make sure that it achieves your goals at your death. From an income tax standpoint, you want to look at your capital gains and your capital losses. We encourage all of our clients to do that. even if we're dealing with between a 15 and a 20% rate, or the unknown of going into the future and what those rates may turn into. So certainly something you want to look at between now and the end of the year. There are no wash sale rules on taking a gain as there are on taking losses. If you recall, the wash sale rules for capital losses means that if you sell an issue and you take a loss, you have to wait over 30 days before you can repurchase that particular security and still leave the loss intact. For capital gains, you can trigger the capital gain and take the loss and take the repurchase the stock almost immediately. So that is available to you should you want to accelerate gains and step up your basis, independent of some of the issues with the estate rules. And I have had clients who have had significant positions step up their basis in those stocks with the fear that there may be an issue going forward. So that's occurring currently, even without the potential change in the law. And then finally, what should we do with our income? Should we accelerate income? Should we pay bonuses or not pay bonuses? Those have different rates depending on the type of entity that you have and so forth. So there are a number of tax planning decisions that need to be reviewed between now and the end of the year so that you can take full advantage of the current law and minimize the taxes that you will pay going forward. So as always, you can give us a call or send us an email. Here's the slide, info@daviekaplan.com. We will be watching it and we will get back to you as soon as we can. Or if you wish to call any of the folks you work with here at Davie Kaplan or with Marcus Kroll, you can feel free to reach out to us directly. And thank you very, very much for attending our webinar.